Hi, this is Kurt Kringelis, Head of Credit Strategy for Voya Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. The rally continued across the fixed income markets in May, with excess return generation slowing to a more sustainable pace. The fixed income markets rallied sharply during the prior 2 months in conjunction with supportive monetary policy, contributing to an easing of global growth concerns and a rebound in commodity prices. The corporate market retraced slightly in May, but the tone of the market remained constructive and performance was admirable given record new issue supply of almost $180 billion during the month. Although excess returns were negative, the energy industry continued to outperform the corporate market in May in conjunction with a further rally in oil prices. The basic industry gave back some of its recent strong performance due to the weakness in certain metals prices. Relative performance results across the other industries was tied to the volume of new issue supply. Industries with the most new issue supply generally performed the best. This result seems somewhat counterintuitive, but attractively priced new issues can at times sharpen investor focus, highlight relative value opportunities, and improve secondary bond trading levels. This seemed to be the case in May, despite the market having to absorb the record new issue volumes. The year-to-date industry relative excess return positioning changed very little during the month. The utility industry moved up several spots on the back of its strong May performance, and the other industrial industry category also gained some ground. The technology and capital goods industries both lost some ground, while all other industries maintained their positions. There is very little excess return differentiation among many industries, leaving open the possibility of further positioning shifts during the second half of the year. A significant retracement in commodity prices would likely be needed for the energy and basic industries to give up their leading positions. Corporate spreads have recovered strongly since the sell-off early in the year. Dovish responses from the Federal Reserve and the ECB, along with stimulus from China, contributed to the rebound. Improved economic growth data during the second quarter has also helped validate the spread move. In the near term, we expect Brexit concerns related to the UK's potential vote to leave the European Union to be the biggest driver of spreads. Once the Brexit dust settles, we expect the focus to return to economic growth prospects and potential monetary policy responses. Also, as July approaches, investor focus will likely also turn towards the upcoming second quarter earnings season. In the near term, we expect some spread volatility, which could translate into a potential buying opportunity if corporate spreads widen substantially in relation to the Brexit vote.